Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm excited today to be here with Rob Johnson, president and a principal owner of CMYERS. Rob, how are you doing today?
I could not be better, especially getting a chance to be on here with you. I've loved listening to your show, and it's one of the benefits. I love studying the industry, working with credit unions, helping them. This is actually my 35th year at C. Myers, so I've had the benefit of working there for quite some time and have just such an incredible team around me. But we constantly love learning, and I learn something every single time I listen to your show. So thank you for having me on.
Yeah, I'm excited to have you on. You know, a lot of credit unions obviously use CMYERS. Some credit unions might not exactly know what it is you all do. So maybe if you could to start us off, if you could kind of walk through what it is CMYERS and you generally do from the 10,000 foot level, and then we'll kind of dig into what's going on in the industry here today.
Oh, would be happy to, and thank you for that. And yeah, it's a shame if they haven't heard of us, but we can
Right.
recommend something that today. You know, we what we really do is I'll say we focus on decision information for decision makers. It starts off that simple. Of course, there's a lot to that, but we started off on the number side of things, asset liability management, things like that. And we do thousands and thousands of simulations a year, but what we also found is a lot of times places weren't using enough of those facts to or those analyses to help make better decisions. And so over time, we built out a lot of technology to help forecast different outcomes and to make more informed decisions. And we actually think that modeling should be about finding opportunities. And so then that grew from there to we do a lot of financial modeling, help places see the future from different lenses to the strategic planning. This year, we'll be doing over 200 strategic planning sessions. And then we do a lot on the execution. We're finding that what was happening is you can have a good strategy, you can know what you need to do numerically, but if you don't execute, if you don't get it done well, then it was all talk. And that talk doesn't actually help the members, it doesn't help the organization. So we have a whole department that helps drive execution and strategic implementation. And what we then found at kind of the final little area that work on is you do all that. And you know what people keep saying is, how do we get our people better to help bring these things along? And so we started years ago getting into leadership development and really training the executives and their teams for them to look into the future better, for them to be a high performing group. And so it's been exciting. Every time over those 35 years, I start to feel like I know what I'm doing. I get humbled by the environment and the different questions, and so it keeps me excited getting to do these things. So thank you for the invitation and asking on that.
You got it. Yeah, you know, you mentioned simulations, and I think of a couple different things when I think of simulations. From where you're speaking, is the simulations about how I'm guessing is like ALM and how your balance sheet's going to respond to the decisions you've made and what decisions you can make relative to moving forward. But from an NCUA perspective, Steve Farr, who's a guy on my team, he used to do Monte Carlo simulations for the insurance fund to stress test the insurance fund to prove to the CPAs that the insurance fund was solvent, which became very important during the corporate crisis when there were a lot of bad investments in the AAA rated investments that were causing challenges to the insurance fund because of the Great Recession and all that. But when we talk about simulations and we talk about making better decisions, what is it? What is it you're seeing out there that you're being able to help credit unions in that regard? Here we as we sit in the second quarter of 2026.
Yeah, one what I'll say is helping people go beyond one budget that is for 1 year and thinking that that tells you what's going to happen. And so a lot of times what you see is people do a lot of work to create their one perfect budget. And you have to have a budget, but everyone, when you did talk with them, you're like, well, how do you feel? How confident is it that that budget's going to be telling you exactly what's going to happen? Everyone's like, oh, pretty much by January, we're already like, well, this is different and that's different. And so one of the things that did is, well, first, beyond just trying to have that perfect one budget, what if in a minute you just saw a totally different path? Well, what if we grew this much instead of that much? Or what if our expenses change at this level versus that level? What if we really push our deposits this way and then look at multiple years? Here's one of the things that we find. And it's kind of one of those common sense things when you think about it. And then you say, well, how are we helping inform ourselves that way? But when you look at places who are doing really well this year, and there are a lot of credits who are doing really well this year, they're having, their position have their best year ever. And then you say, well, is it because of the work you did this year? And of course, the answer is no. It's not because of the work I did this year. It's because of the work that I did last year and the year before and the year before that, building up our strength to be positioned to do really well right now. So why is it if we know it's obvious that it's not because of what I've done so far as of April that made us look really good right now, then why do we then do our planning for a 12-month window? It doesn't make sense. We need to look further out there. Sometimes the actions that are going to build that strength for you, if you just look at 1 year, that doesn't build much momentum. Maybe we don't worry about that right now. But if you look further out and you see, oh, this builds momentum that would really help us. And down the line, our future selves are going to be thanking us today for making this happen. That if we start doing these steps right now, that we're going to actually build a lot more momentum towards good things that are going to make us stronger in the future. And so one of the things that we do, and technology is amazing these days, is in technology, we'll take a forecast and you can test, well, what if we change it and we look at our next 5 years and you'll see an answer in less than 1 minute. That's incredible. And so there's no excuse not to look out 3 to 4, 5 years, not because you're trying to have, here is the scenario. No, it's let's paint the picture. If we just take a minute and then we start laying out each of those different directions, then you start actually getting a really good feel for where the exposures are, where are the opportunities, where are we going to get stronger? How do we need to target our team? And so I think that's a really big difference is, as you said, sometimes those Monte Carlo models that you're referring to, it might take someone weeks to really say, okay, here's what it is. And then it goes through, shows that risk and they're like, oh, that's unlikely, or we're okay there. And they start to discount it versus starting to really start seeing clear paths. What happens to our earnings? What happens to our net worth? How are we achieving our goals and our growth over this? Are we excited by that? And that really connects to strategy once you start doing that.
Well, and if you, how do I want to say this? Like you said, budgets are wrong in January. Once you get there, right? That with every simulation, the one thing you know about it is it's not right. But it can teach you a lot. It's going to get you to start thinking about it. And if you go out 1, 2, instead of 1 year, 2 years, or instead of 2 years, 3 years, you start thinking about, okay, in 4 years, this is where I'm going to be. Is that really where I want to be? And if it isn't where I want to be, what levers can I control today? I refer to a handful of books on occasion, but one of my favorite books is Atomic Habits, right? And if
Great book.
yeah, and it's like if you want to become a runner, don't go out and run 5 miles. Go run around the block, and then do that for a week, then run around 2 blocks, right? And then incrementally over time, every week you're able to do a little bit better. And the same thing rings true to a personal financial statement or a complicated or more complicated financial statement like credit unions. Does that make sense?
Absolutely. It makes perfect sense because that time on feet that you're talking about, you start strengthening up all those muscles that support you. And so you'll hurt yourself if you just, well, this is it. I'm going to just run out, too long, too fast. No, let's build up our muscle. Let's build up our strength. And that time on feet then starts to actually make it easier to go further. And so as you start going through, we have a lot of our clients, what they do is every single quarter, they're looking at multiple years because they're continuing to see, well, what's this look like? Not to calibrate to the one perfect. That's why we keep mentioning that is no, it's so easy to see these different directions. Now you get that habit, you start building that muscle of thinking further out. As we think further out, we start to see problems and we see opportunities clear. And then, well, it's easier to take those actions right now. And that habit, that time, walking through and thinking strategically, that's a muscle you need to build. And so seeing those implications, a lot of times people are like, well, I thought if we just grew really fast that this would be a good thing. Well, which kind of growth? let's play around with those different levels of growth. You grow this way, it looks good next year. It really starts to hurt you the following years because this is what's happening to your cost of funds. And you actually are building up the relationships that you might be looking for. But if you do it over here, it might take a little slower build up. But if you're doing it well, you could actually be serving more members. You could be giving, them benefits while you're getting stronger over time. And so that can really help them then get used to as a team how to get more clarity. And that takes just practice. And so if we just do it once a year, we're not going to get that time on feet. Do it throughout the year. Strategy, the strategic process, it should be viewed with urgency and thoughtfulness throughout the year, not one session at the end of the year to say, well, now it's time to strategically think. That's not going to work.
And so let's say someone hires you and says, "Hey, we're doing our strategic plan. You asked for some documents from the last strategic. Probably, I'm guessing you'd ask for the last strategic plan. You'd ask for
Yep,
the budget.
absolutely.
You'd ask for maybe a sample board packet or two. You'd probably interview some of the key players, and then you've kind of got so you learn a little bit about them, and then you've kind of got your framework of how you would tee that up. So then you show up at their meeting. They have 3 days set aside. Maybe one of them's devoted to you presenting and walking them through the strategic plan. As you're teeing that up, how does that play out in the credit union's
How does that
eyes?
work?
Yeah, how does that work?
One, is you're talking about that process. Here's a lot of times what we see is there's a wide range, of course, of strategic plans, different levels of depth. I will tell you, love AI for a lot of this too, because hey, let's take your past several strategic plans. Let's look at what's been happening here, run it through, help summarize it. But a lot of times what we find is before we would say, oh, let's go to that meeting on that date. No, let's first start talking now about what are you looking to accomplish? If you have a 70-page strategic plan, but no one can actually explain what you're trying to do and how you're going to be making those steps forward, then we might actually need to work more on that clarity and alignment. And let's get it to these are simply the most important things we will be accomplishing. And so sometimes it's actually to simplify it a little bit more to get the right things done instead of putting everything in there. And then we see so often that there's this, I'll say, strategic fatigue without progress. You don't want that. And so what we'd like to do is first, well before that session out there is let's look at it. Let's start to lay out a plan. Let's then look at the numbers because a lot of times people don't actually test. Can we even afford to do what we're talking about doing? Or here's the fun side is you look at a lot of credit unions right now. They haven't been getting as much growth as they would like. They're not growing their memberships as fast as they want, especially engaged members. And, a lot of places would like to do more of that, but their net worth ratio has been going up. Now, you start going through and you connect, well, how much cushion do we actually have in our net worth ratio? And that isn't as simple as, well, if I have 12, it's too much. It's 12. No, whatever that number is, understand your risks. Understand how much exposure you might have. And that's where some of the scenario planning comes in. But then look at some of your different opportunities and say, well, if we started, actually, we have a cushion here to do even more than we thought. Those are the great ones to be able to do because, yes, you have that situation where, maybe a place needs to slow down or do something different. But normally what's happening right now is people are starting to realize I actually need to accelerate and have a little bit more of a sense of an urgency as to what we're going to accomplish. And so that takes, let's lay out the plan and thoughtfulness now in April, for example. So we have a lot of people at sessions right now in April, really planning out, let's do the real work as a senior staff, thinking through things, then do some sprints along the way. How do we solve these problems? And then towards the end of the year, you've been bringing the board along. And then that October session or whatever date it might be is really just helping to crystallize at that point. But those who kind of wait until that October, it starts getting slammed in there with the budget process. And now what do I do? And I'm back to short-term thinking versus long-term thinking. Well, if you start earlier, what happens is you actually see a lot more opportunities. I was raised the CMYERS is for Cliff Myers, and he always said the point at which you address a problem is directly related to the number of viable options to solve it. So in other words, you start sooner, even if it's not perfectly laid out, you're actually going to see it better. You're going to see it different. You have more options. You start to figure those options out early. Well, what happens is now you can start to lay out your plan. You'll start to understand what your costs are, what's your cushion for your earnings and your net worth. So you have a very deliberate plan, and here are the alternatives, here are contingencies. Now your budget gets easy. Budget actually should not be a nightmare. Your budget should already be almost done if you actually have a really clear strategic process, and it should be more top down of here's what we're trying to accomplish. Here's what we need to do as a team. Now we need to have this much room. Then let's work from there as to how we might execute on the operational side of that. That actually is very freeing to people once they make that adjustment, and it has them focused on the future better. And one thing learned over time is if we're just focused on what's right in front of us in the near term, we actually have more of a risk of running into things that we aren't positioned to handle well. But I learned one of the things that did was I turned 50 a couple of years ago, and leading up to that, I said I want to learn something new.
Yep.
And I learned how to ride an adventure motorcycle, and
Oh,
I'm riding a 500 plus pound motorcycle going up a dirt side of a mountain. And I learned that one, it takes a lot of balance. You're
yep.
standing up on it the whole time. You're shifting your weight. You're trying to adjust to the terrain. So again, we got to get our balance down. And it was interesting because as I was learning this, it helped me think about the credit unions and our business model and what we do together. And there are a lot of parallels. And you have a lot of time thinking when you're out there. So we got to know how to balance. We also need to know the throttle and the speed control. There can be too fast, but there's also definitely too slow.
Right.
You're up on the side of the mountain, you're climbing up it, and you go too slow, you're probably going to drop that bike. And you don't want to lift up a 500-pound bike on the side of a mountain and try and restart back up. So some of that is we need to see out there, we need to keep our momentum going. And then if you're looking ahead, because what's happening, I would get myself in trouble, and I had instructors help me. And that's some of what we do is we help people through instruction and help them see it different. Is they would keep teaching me, they're like, Rob, you need to spend 5 seconds looking way out and 1 second right in front of you.
Right.
Because if you look way out, you'll see what lines you should have. You see where the big problems are. You learn to then focus on where you want to go. Understand that those problems are there, but don't stare at them. If you stare at them, you're going to wind up hitting them.
Yep.
But if you know they're there and here's the line, you either want this line or that line or that line. I'm good with any of those. You start narrowing on that. I see that. I know I can roll over anything that's right in front of me. And so I just do little peaks down here. But if we stay out there, we'll be on a much better, smarter line. And it's actually a lot less work. And so when I would normally fall is if I'm staring right in front of me and I get really tense. And if you get tense and you lock up, I'm down.
You're done.
And the last scratch just to prove it.
So I wrote down a few different keywords you said there. Affordability, momentum, adjust to the terrain, and then one you didn't say, but well, I think you did, but it came to my mind, is net worth. So, adjusting to the terrain right now, competition is huge in credit union amongst themselves, amongst fintechs, amongst Bitcoin, amongst stablecoin, amongst banks, which probably is putting a lot of that pressure you referred to on growth. When I think net worth, I'm just going to kind of spitball some thoughts on all of these, and you can take it wherever you want. When I think of net worth, I think of someone who went into a challenging period with 7% is having a lot more problems than someone who went in it with 10, 12, or 14. And if you're one of those that went in at 10, 12, or 14, are you looking at maybe turning that throttle up because of all this competition? Maybe you're needing to look at an acquisition of whether it's a bank or whether it's your low income and getting some sub debt and doing some more for your members, or looking for another credit union to merge in. And then affordability with inflation and the chat. NCUA has gone through a 27% down staffing at NCUA, creating some of their issues. There's what's going to happen to white collar workers because of AI. But it always seems that credit unions, NCUA, even in a good day, NCUA is about 5 to 7% understaffed, filling vacancies. Credit unions are always kind of, even in good days, trying to fill staff, but the competition out there for talented people. And oh, by the way, you got to pay them 20% more than you did 2 years ago. That was a lot I threw at you, but pick any of those to run with.
A lot of good parts of everything you said there. What's interesting is when I think of a lot of the pieces that you're saying, I'm actually going to jump industries for a moment and talk about the dark side for a moment from a creating perspective. But I love watching and listening to what Jamie Dimon says, and you can learn so much from him. And so when you were walking through and saying that, it's like, well, let's look at what he's done in some of his messaging and what I heard with the connection on the net worth and going through things. And then this will connect to mergers and different opportunities is he has said hundreds and hundreds of times publicly, and it goes back to the early 1990s, build a fortress balance sheet. And it's one of his foundations. You build a fortress balance sheet. Now it's interesting because then we wholeheartedly believe in that, but we need to actually work on defining what does a fortress balance sheet mean? Because a fortress balance sheet does not mean take my 14% net worth and take it to 18% and lock down and it's not an old outdated castle that is just stone and it's immovable. A fortress balance sheet, and he's proved this over and over again, is one that's actually very dynamic. It's fluid. It can handle a lot of things. It is reaching out to different areas, but he accredits, he says, we run hundreds and hundreds of simulations. I understand where the problems are. If I understand where the problems are and I understand where the opportunities are, then I know how to balance that out ahead of time. And so you look at that and you think of what he's doing there. Well, then he says, we got to have strong capital. We need to price in our risk appropriately. And we need to have strong liquidity at all times. And then as we go into different initiatives, we need to diversify our earnings, but we need to do it in a strategically coherent way. So it needs to make sense for what we're trying to do. As you look at then what they've done is each time there's a crisis, they actually leap much further ahead. They go out and they make really inexpensive acquisitions that then typically pay off for them, but they're positioned with that strength that you're describing is how do we go into this? And we see this on, I'll say quite a few credit unions have done a fantastic job of how they position their fortress. And a fortress is not the place that we're not going to earn money and we're not going to move. No, the fortress is, some of the credit unions that really strong earnings, but diversified. Their risk profile is fantastic. They look at a lot of different scenarios. They're spending their time years into the future, and then knowing that they can roll over the challenges that come at them. I think when you talk about this environment, it is an incredible opportunity for credit unions. We can and we see two camps sometimes. You see those who are like, oh my goodness, the world is moving too fast. And we're like, it's going to keep moving faster. So if you're not comfortable with it, then you might need to adjust that mindset. And those who are really excited and positioned because of all the amazing things they're doing for their members, the social impact difference that they're making, the value that they're adding. Well, when you talk about all that competition coming in, there's also this other major thing that's happening is while leaders are feeling stressed, the population, people are feeling a lot of stress. And you're seeing that. Well, credit unions really should be a solution to that stress. We're positioned for that. We should be creating that trust. We should be creating that understanding. We should be creating that sense of community. We should be making that difference for them and creating extra loyalty for them to say, wow, you not only know me, but you help save me money in the right areas. You help me get a vision of the future. And so if you do that well, in a time of stress when people are feeling it, you're going to have a member for life. And it's really focusing on that engagement, that making a difference. And some of that, frankly, comes down to focusing on the right metrics instead of, I'll say, some of the simple metrics that places go for. They can be short-sighted and it can cause them to miss opportunities.
Great point. Great point. And as you're I kept thinking Warren Buffett when you were talking about Jamie Dimon, because Buffett kind of he's got a lot of good investments and his balance sheet has
He's doing okay.
yeah, right.
Doing pretty well. Yeah.
And that, but he's there ready to when what is it
When the tide goes up, tide goes.
thank you. Yeah, when the tide goes out, you know who's swimming naked, right? So he's there to take those opportunities, which is kind of what Jamie Dimon is doing, getting ready to get some acquisitions at a good price because they're aggressive and in being well positioned, but they've also kind of got some cash and liquidity on the ready to
Yeah.
go, so they don't run their liquidity too tight. What is it that you're seeing? You know, the with the 500 rate shock that we never expected, and then NCUA was beating up credit unions around NEV, oftentimes for good reason, oftentimes maybe just because that tool isn't the perfect tool, and people were maybe getting beaten up by it a little bit. But things have gotten a little bit better, generally speaking, or like in totality, liquidity's at a better place, even though growth isn't where they'd want it to be. NEVs are generally better. A lot of credit unions made some pivots because of that. What are you seeing in that world today, and maybe over the next 2, 3, 4 years?
Yeah, I'll say, one on the last 2 years, it's what you said, and we see it, I'll say, proven out in the numbers. One of the things that we do for our clients is we'll actually provide a graph of here's all the NED answers for any environment you're interested in for all of our clients. And where do you stand? And how have you changed? How has the industry changed? Well, what we find is when we look at those graphs, the economic values have improved hundreds of basis points over the last couple of years. And there's that the time heals with that adjustment. Does that mean that the risks that were shown in some of the models were wrong? No, because those risks that were shown in the models were okay. Now that rates have gone up, they're then shocking different environments from there. Rates did not keep going up after rates went to the 5% level short term and the long term rates were around 4. Rates since stayed there for a while and started to go down, and that helped heal a lot of structures. But also places started shifting a little bit of what they were doing on their pricing and their risk management and connecting that. What I see looking at it then is we've seen more net worth strength. We've seen more economic value strength. We have seen more pressure on the operating expenses and more pressure on the non-interest income. And those are kind of a combination where the growth is, but life is, as you said, more expensive. It's more expensive to have really incredible quality talent. It's more expensive on the technology front. And so how do we then position ourselves for scale? How do we make sure that as we're investing in technology, we're actually doing smarter contracts that don't make us afraid of the scale because it'll cost us too much if we wind up doing this. And it's amazing how sometimes places like, oh, well, we signed on with this new fintech to do this. And we're like, okay, so what if it's really successful? You get millions of your members, 1 million members to do it, or a couple 100,000 members to do it. They're like, oh no, that would be horrible. We're like, what do you mean? They're like, we couldn't afford that. Well, then why are you doing it?
Right.
Are you not thinking of the future and the scale? And so we need to be smart about how we're approaching our expenses and those contracts to have it where we're positioned for success. And we have that growth mindset. We are seeing that those things, though, don't get captured by that economic value. Economic value does not care if interchange income goes away because it's just the value of your assets minus the value of your liabilities. It's ignoring your non-interest income. It doesn't care if your operating expenses go up 10%. And so that's where earnings come in, and understanding really your risk to earnings and pulling those things together. That's where really trying to get that all those parts of the strategy levers to work well. And that's where we see how do we generate enough earnings, make them sustainable so we can keep doing great things for the members and keep expanding and accelerating our strategy. We have to look at it from a measure that captures that. And so it's looking at the bottom line earnings instead of just stopping at the margin. And that's something that we think we've worked really hard to help people see that. Those who really see it, the world looks a little easier because that information helps them then see, well, what are our opportunities? What do we do? When you're looking at going forward, we do hundreds of forecasts. Help a lot of places, not just, of course, with here's what they're expecting, but really trying to push out different environments. Understanding, of course, right now, some of the outlooks are concerned about higher credit risk. A lot more uncertainty on, a year ago, everyone was like, rates are definitely going down. Well, the world keeps changing a lot. And then they're like, oh, maybe long-term rates won't be going down. Maybe they'll keep going up, depending on what's happening out there geopolitically and all those pressures. And so as you look at it, one of the things it will also encourage is understanding different yield curves. One of the problems that happens is the simplification of the environment. Oh, rates are either current, +123 or -123. If that's your lens, you don't even know what the definition of current is. And you don't know how things move when short-term rates move versus long-term rates. And so there's opportunities in understanding that and seeing some different yield curves, seeing some different pressures, and where we might actually do better on this. Or if I see a pressure, what I find sometimes, and at our place we find, causes some challenges for people is sometimes people don't want to see a problem. And so we need to change that mindset. And need to change your mindset to, if I see a problem, I can do something about it. But if we don't want to see it and act like it's not there, then I can't act on it. And that's part of what Jamie Dimon is talking about in his Fortress balance sheet, is I need to know information is power. Where are my risks? Where are my concerns? So I can act on it. And so as a CEO for an organization, they need to be demanding, show me our problems. Show me where we could be hurt. Oh, if the yield curve does that, that'd be a problem. Or this would be helpful. Instead of just that current 1, 2, 3. Life never moves that way. But I think it's one of those simplifying assumptions that people just tolerate and say, oh, we're doing it for the examiners. Well, no, do it for yourself. Demand better decision information.
No, that makes great sense. And so I wrote down ignorance is bliss, right? You can't when you're audited by your supervisory committee and you're examined by NCUA and you have more competition today than you ever had, putting your head in the sand is not a strategy. It's a strategy for maybe being on next quarter's merger list. Yeah, and then you're thinking about what you just said, and in the back of my mind, with my NCUA hat on, and NEV, I've called that a rough justice calculator. And Todd Miller, who's on my team, when we're on with having client conversations or when we're talking on the podcast, when he talks about NEV and he pauses, his pivot is, I always preferred income simulation, which is a little bit of what you were walking through. And the different yield curves really determine that. And then swinging back a little bit to inflation and affordability, that's there. You got to watch every dollar. But on the income side, what type of opportunities or what are the headwinds relative to the potential for new streams of income to help that net interest margin, to help that income simulation in your projections this year, 3 years, 5 years?
Yeah. What I'm going to do is I'm going to answer using a name of one of our clients, just because they've said we can, and normally keep everything very
I love it.
but because I think it then just helps provide that real world examples of what they're doing. And it's Redwood Credit Union. I don't know if you're familiar with Brett and his team. They're normally not going to be on the regulatory radar because they've been, historically over the last 2 decades, they're earning a 125 to 150 ROA. Their net worth strength is incredible, but they get a lot of growth, and they're always focusing on the strategy going forward, on the asset liability management. They're some of the just top answers out there. I bring this up and I use them as an example because then you said, well, what do you look at for different growth opportunities? And so they're about $10 billion right now. They were, dealing with some of that. Do we cross at the end of the year?
Yeah.
That, because for those who are familiar, essentially when you cross, and it depends on the organization, but Redwood's been incredibly successful having a lot of engagement in checking accounts or, share draft accounts, whichever label you like to use. And what happens is then they have a massive debit card penetration, which is great until you cross 10 billion. And it's going to cost you about $20+ million in earnings. just for crossing that magical line. And, they viewed it years ago as all that's going to do is just take money out of our members' pockets. There's no value add with this shift there. This isn't helping the members in any way. And so I'm going to say combine the challenges of the environment with if you're also facing, okay, as I cross 10 billion, it's going to hurt me about $20 million in earnings. Now, what's my sense of urgency? If you view growth and earnings potential with the sense of urgency of I need to look 3 years out, 5 years out, what do I do? So what they did is in their strategic plans, they said, okay, what do we need to do to be number one in our markets for mortgage originations and really build these relationships up? And so then they went through and, really dedicated process of getting in there better with realtors, really owning some of this market, having really efficient processes while still having good rates. Bring that up because we're still finding a lot of places where, oh, well, mortgage rates are so high, we're only going to get so much volume. Well, this might actually be the time to try and dominate that market, to try and build some of that, especially if you have the ALM and the net worth strength to do it. And frankly, it's so funny. I still run into people who are afraid to put on mortgages at 6.5%, but they put on a bunch of them at 3. That doesn't make sense.
Right.
And so, okay, so we're gonna work on dominating that market, but we're also worried about debit interchange going down. And a lot of places are facing this. There's a lot of regulatory pressure on what interchange income will look like for debits and credit cards. And so then they're working on expanding the products out. And then, okay, well, what's this product pressure of overdraft income? And so they're like, well, look, let's go ahead and hit head on. They're in California. Overdraft income is extra tight on, the caps on it. And so then they came out with a new benefits checking account. And the benefits checking account is, they're like, look, this is giving our members $75 of value every month. And all they have to do is pay us $7. They then actually still make non-interest income on it, but it's really popular. And the members are like, oh my goodness, you're helping me if my car breaks down, get to the shop. You're helping protect my cell phone. You're helping do these things. And you're creating this as an option for us right there. They're already getting all these letters from the members thanking them for how it helped them. And it saved them so much more than $7 a month. So they're actually hearing it from the members as the social impact side. But what they're also doing is they're diversifying the income while actually getting a lot more attention and growth on a lower cost of funds. And so I think some of it, while these are just a few pieces, come down to product design and thinking through product design and execution on it. And then, of course, are we having the right implementation? And so when I look at earnings opportunities, I think, yes, there's earnings opportunities on the lending side. I think a key part is actually going to be how do we grow core engaged members? Some of the, I'll say the addictive side of things, if we aren't careful, is some of these single product members that we bring in really quick to get a fast growth, to say that we hit this growth, but then they aren't actually engaged with us. And so how do you design your products to motivate more engagement and then to motivate the members to do even more with you? Because at the same time, they have a really high money market rate. They're paying today 4.15, but only for members who are engaged with them, who, they have direct deposit with a certain amount, and they have it where you're either borrowing from us or using our CUSA. Because they're like, if you don't have money, you don't need to borrow because you have plenty of extra money, then are you part of our wealth management or do you use our insurance? But then what they do is they do a really good job connecting different areas. So someone starts coming in for, remember, we talk about buying, getting a new mortgage. Well, when they're getting a new mortgage, they're checking, do you know that you're overpaying by $1,000 on your insurance for your homeowner's insurance? One, let's either save you that $1,000 a month, or this actually could let you have more money to borrow if you would like. So giving the members options, saving them that money, that's going beyond. And so what I bring that story up because it took actually Brett and his team, they're looking 3+ years out always. They already right now in early 26 have their key bold steps done for next year as to what's it going to look like? What are we going to have to do? It doesn't mean that they know the future, but they actually scenario play so much. And so one of the things that Brett has constantly told people, he says, what's really nice is when I see they do all these tests trying to break the credit union. How do I break the credit union? And they were doing this well before crossing 10 billion. But he knows, okay, here's what it would take. That makes him actually make decisions faster because he knows he can act on an idea, act on an opportunity, and it's not going to break the credit union because we have that cushion, we have that room. And that's connecting back to what you said earlier about there's knowledge is power, but ignorance is bliss. He's like, no, we are not going to go the ignorance route. We are
Right.
going to actually embrace learning and knowing more. And so there are a lot of pieces on that, but it's how do we grow? How do we grow appropriately with, being smart about getting engagement, doing it not just through rate, but if we're going to pay a really high rate, we're going to make sure we have a relationship with members and we're building something for the future. How do we get better at our lending side of things? And then competition, it's so interesting, when we talk about growth is I like to ask the question, well, is your objective and is it better to grow through experience or grow through rate? And people are, like, well, I can grow through rate faster if I just lower my loan rates or I raise my deposit rates. Experience takes time. I don't know if it'll happen. Experience is, making easy for them using technology, and there's a cost to that. And I'll tell you in the end, Mark, it's kind of a trick question because it can't be one or the other. We have to have an incredible experience. We have to keep, they are constantly focused on their technology, the experience on their apps. What is happening? Is it, studying? Is it, how do we shave seconds off of it while making it more engaging and beneficial to the member? But at the same time, we have to, while we're focused on our experience, we can't have a great experience and horrible rates and get the growth that we want. We need to have a great experience and we need to keep improving it. So they actually have a whole program for how they study their products, how they improve them over time so that they aren't just complacent with what was good 2 or 3 years ago. Doesn't mean it's going to be good going forward, but then paying good rates. Doesn't have to be the best rates, but we need to be competitive. And then we have to have it where it's fantastically easy for them, lets them want to do it more. And then all of a sudden your members are your best salespeople. And they're like, the difference that it made when I went to a place that really thought about me, cared about me, made it easy for me to do these things, paid me a really good rate. And now here's what I'm doing next. That's what I think credit unions need to be focused on. Is it's really pulling together our strategy, our execution, having that deliberate, is our product mix right? Anyone who sits there and says we're a commodity business, that is wrong. You're not. Credit unions are not a commodity business. Those products and what you're doing and how you might design it and the experiences you're creating, these are people we're dealing with. You're helping people. And so really looking at it that way and be driven by, I'm going to make a difference for more people and I'm going to do it in a sustainable way. And so that's kind of a long answer to your question, but
It's a
passionate about it.
it's a good answer. It's a long answer, and I wrote down a lot of words, so I'm gonna throw some stuff back at you here as we get close to the end of this. But you said execution earlier, and I had already written down Super Bowl. I'm gonna weave into Super Bowl, but back in the 1970s, when John McKay was the coach of the Tampa Bay Buccaneers, they were the first team to never win a game. They went 0-4. The season was only 14 games back then. They went 0-14. Afterwards, he was walking off the field, and an interviewer said, "What do you think about your team's execution today?" And he said, "I'm all for it." So the opposite of that is what you were talking about, is everything working well together. What do you have to do to win the Super Bowl? To go 16-1, 14-2, you got to have a good offensive line, a good defensive line. You got to have a good quarterback. You got to have a good wide receivers and a good defensive back. You don't have to have the best in every one of those. You don't have the best rates. You don't have to have the best court. You don't dominate at every place, but you can't really have any weaknesses of materiality, or that weakness is going to end up causing you some problems. And then the other thing, when I think of that, I think of cross-selling. A lot of what you were talking about is if they come in and do this, you got to be able to do that. But the way in my mind, organizations cross-selling can have a negative connotation. Like, well, I came in for this, but you're trying to give me that.
Yes.
But if you have good leadership training and you understand the organic whole of the organization, you're offering them some other things they might not be aware of. And if it's framed right, and the call to the call center was good, and the teller treated them well, and whoever they dealt with was impacted by good leadership training, which trickled down to a really good culture. That culture, that culture can be as important as the rate.
Absolutely. People aren't going to remember that difference of 25 basis points. They will remember, wow, you treated me so well. It was such a different experience than what I'm used to. You knew this. And as you said, you aren't just trying to force a cross sell. You understood my needs. And there are two things that as you're talking there, and I do love I agree 100% on the execution on the Super Bowl side of things, that our team has to be really good in a lot of areas. And so one of the things that, for example, they do is it is strategic planning throughout the year, but they have a large expanded team that they actually go through the entire strategic process. They're like a group of 50 people involved. And so we talk about this all the time, that yes, we could actually get near term, the strategy is done faster having less people involved. But if we have them involved and if they understand it, they actually start to permeate it throughout the organization and they get it. They get it more. And that's going to help with the execution, because it's not just a group of words up there. It's really getting to the why and the difference that we need to make as a team. And so, Bright's always like, I know we could be more efficient at this, but I want to be effective down the road and keep building my team. And he invests a lot in his team. And that makes a difference. That's how the team works better together. It's the blocking assignments and understanding what each other are going to be doing. That's what makes a great quarterback, is actually that front line protecting them.
Yep.
Because you can take a great quarterback and give him no front line, and it's not going to work very well.
And he would be playing for San Diego. Yeah, that's
I have the Arizona Cardinals here, so we can think about bad teams.
right. Well, I'm hoping Kyler Murray does amazing things for the Vikings, because I'm a Vikings fan. So we're glad to have your quarterback. We think, but we're
Well, yeah, we got so much for him too,
right. He's only costing us $1 million, but
yes,
that's a whole other podcast. So
yes, it is. Yes,
yeah.
it is.
So Rob, this has been fantastic. Is there any other topic you want to hit before we wrap up here today?
Well, Mark, I have the feeling you and I could probably talk about a week long without overlapping too much on the topics, because there's so much going on. But right now, I hope that we gave your listeners a lot to think about. I hope that they walk away feeling motivated and excited for the future. And that's the kind of energy and mindset that we need. I hope that they're focused on that execution and what they do and the difference that they could make, and really spreading that vision and looking further out instead of what's in front of them. And if we're just dealing with all the problems right in front of us, it's a lot more likely that we're going to be stumbling. And so the more that we get our head up, we're looking out there. And if they need help, well, obviously we love doing this stuff. We'd love to help more organizations, but I just appreciate the opportunity to be here with you.
Yeah, this has been fun. I've enjoyed it. And if someone wants to someone has listened to this and said, "Hey, yeah, I need to talk to Rob, and I like what he was saying there, and I think he could help my credit union," how's the best way for them to reach you?
Well, one, I'll say the best way is CMYERS.com, because our team, you think it sounded hopefully good enough, but our team's out there doing the real work and helping a lot of people. So that way our whole team is there to help serve. We have about 80 plus people on our team helping organizations, and, permanent, very focused on the credit unions and the difference for them. Me personally, I'm R. Johnson at CMYERS.com, and I'd welcome contact too.
That's awesome. Rob, this has been a lot of fun. I want to thank you for your time today.
Yeah, this is incredible. Thank you, Mark.
You got it. And listeners, watchers, I want to thank you for listening or watching. I hope you'll do the same again soon. This is Mark Treichel signing off with flying colors.